Okay, so I wanted to go ahead and just show you a couple of charts before I continue. And of course, I talked about the deflation in Europe, and you can see here this is one gauge of inflation, or I guess relative inflation or deflation. You can see that producer prices in the euro area, the change in producer prices. And of course, the producer prices are thought of as a leading indicator of consumer prices, right? Because of course, when producers experience an increase in prices or decrease in prices, they can pass that along to consumers. They don't always do it, or it's not always predictable in terms of the delay, but it usually happens at some point. So you can see here, since around mid-2011, you can see there's been a deceleration in the producer prices, or the change has been decreasing, which is another indicator of deflation. And in this next chart, this shows China interest rates since 2007. As I mentioned before, China is showing some signs of deflation. Interest rates are going down, and so China has lowered its interest rates. It's the first time in more than 2 years it's lowered them. You can see it's 5.6%, and the record low was 5.31% in 2009-2010. Also, since that time, China has lowered other rates, repo, overnight rates, and so forth. So there's clearly they're trying to do as much as they can right now without an all-out stimulus. So I think that there's more downside to rates in China in coming months, probably over the next couple of years. You'll note that this interest rate cut caused the Shanghai Composite to rally by 9.5%, right? And that also accounted for the spike in the FXI, the Chinese major market fund that we cover. So keep that in mind. I mentioned that in the emerging markets forecast. These are things that, if you're trading these things aggressively, especially you professionals out there, you're not going to miss this stuff, right? These are things that are pretty obvious, right? There's problems in China. China needs to loosen its policy, needs to help with the liquidity, needs to help with the credit bubble to kind of release some of the tensions. And of course, a rate cut is a fairly benign way to do it. And that's what happened. So, of course, the markets love that, and they soared. Now, the problem is, of course, is that's only a short-term remedy. Most often, it signals further problems down the road, right? So, the point is you're not going to solve a big problem like what China has with a rate cut, or even a series of rate cuts. They're guaranteed. There's no way. And so the next chart just shows how the Brazilian interest rates have been on the upswing. Now, of course, you can see beginning in the spring, in April, they were flat. They were not raising anymore. And then you can see this bump up here after Rousseff won the election. And clearly they're going to hit 12% over the next couple of months or so. And then I think above 12% probably before the summer, and maybe even 13% by late 2015. We'll just have to see. But the important thing is that they're raising their rates. They stopped doing that for a while, and that took everyone by surprise when they raised these rates. But once again, I feel that it's really the only thing that they can do at this point to help mitigate the problems in the economy. And that's why I forecast Brazilian rates to go to 12% and higher starting in early 2015. And so the final chart that I want to show before I go on is the chart you can see here. I mentioned this in the emerging markets forecast, that India has been the top performing emerging market stock market over the past year through October 31st. You can see much higher. And of course, India has been the emerging market that we have focused on. We have been very bullish on India for a very long time now, around a year, maybe a little more. And so we've nailed that. Going forward, of course, well, I'm not going to give away the forecast in this video, but you can just check the emerging market forecast for December 2014 for our latest on India and the other emerging markets, China and Brazil. Okay, so I actually wrote down some notes because I'm going to be doing a lot of talking here, and I think some of the points are pretty important, and I figured that you're probably going to take notes on your own. So I just decided to go ahead and write this down, and so that you don't have to. You can at least follow it easier by reading it. So I've done a video on this before, maybe a year or two ago. I'll try and find it. If someone can find it, let me know, and I'll post the link, or I'll notify you where it is. But I actually did a video. It may have been in November or so of last year, whereby I basically summarized what had happened in the global economy since the financial crisis, right, where we had the emerging markets led the recovery, right? Brazil escaped the recession of 2008, 2009 before all other countries, followed by China and then India. And of course, we had the advanced economies that spent a longer time in the recession. And then, of course, we had arguably much of Europe has been in a recession for much of the time, or most of the time since that period. Of course, it hasn't been reported. You've got at least what is called so-called, and I'll use the term, I hate using these stupid buzzwords because they don't really make sense, but double dip recession. But we're looking at a triple dip recession, really, in Europe. Anyway, after this period, of course, the stimulus, global economic stimulus, which is what fueled the emerging markets, which helped pull the advanced economies out of the recessionary quicksand. And then you saw the U.S. and Western Europe diverge from the other advanced economies, specifically in other parts of Europe, right? Especially, of course, the peripheral nations, Greece, Spain, Italy, Portugal, Ireland, and then also other parts of Europe as well. And now after that stimulus ran out, of course, we were on top of that. We were already expecting the stimulus to run out anywhere between early 2011 to mid 2011, some even late 2011, but we saw what was going on, and we realized that Brazil would have major problems over the coming years. And we also saw the deflation of the commodities level as these stimuli ran out. That's exactly what happened. And so in the third point here, the emerging markets weaken as the US, Japan, and UK, and of course UK was more recent, strengthen while the EU weakens, right? So the EU has kind of been weak, especially since 2011, 2014. And, there have been periods of kind of upside and downside and so forth. But overall, we just put 2011, 2014. And, of course, the fourth point here, Western Europe weakens along with the rest of the EU, joining the emerging markets. The USA and England lead the way. So Japan is weakened, right? We talked about that. Their huge contraction second quarter, and their contraction, I think it was of 1.6% in the most recent quarter. So they're in a recession, right? And it's due to that increase in VAT. And so we're seeing now, of course, Western Europe, which I talked about several years ago. I talked about France and even Germany being pulled down by the weakness in the EU. And I'm not going to get into how I feel Germany should just get the hell out of the EU. I feel bad for the people of Germany. That country has gone through so much over the past century. It's amazing how resilient Germany has been all these decades of. But anyway, that's another topic. So, and I mentioned, of course, how I think the U.S. is going to continue with this positive economic momentum going into 2015. I think England is going to weaken a little bit. And Japan, who knows what's going to happen there. I think that overall, though, Japan probably, from an investment standpoint, at least intermediate term, I think is probably looking pretty good. I'm not talking about the yen, of course, unless you want to go short. But I'm talking about the equities in terms of valuations. And, of course, you have to keep in mind that a weak yen generally bodes well for the equities, right, to some extent. Okay, so I also wrote down some keys, some investment keys, just to keep in mind. This is one thing that we have to first keep in mind, obviously. It's the overhanging fruit of the capital markets. That's the interest rates, the historically low interest rates, which has served to keep more investors in stocks versus bonds, right? And I've talked several times in the past about what's going to happen when rates increase. We'll get into that a little bit later as well in the future. Once again, for those of you who are newer subscribers, keep in mind, go through every single video and audio presentation that you can, that we publish, because in addition to the monthly forecast, I'm always trying to offer educational points so that each presentation you watch, you should learn things in addition to the forecasts, okay? And in the future, I will go over the fixed income versus stocks and interest rates and how all that's played out. I know I've discussed it in much more detail in the dividend gems. I've actually done a lot of videos on dividend gems lately. I'm probably going to do more on dividend gems. I might even start to transition dividend gems into a video presentation. If any of you out there, well, I know a lot of you get dividend gems who also get Intelligent Investor, and some actually market forecasting also get dividend gems. Send us an email. Tell us what you think about those video presentations on the securities. If you like that, it's a lot more effort, I can tell you that. So the second point, of course, record corporate profits and record profitability in the U.S., right? That's been a driving force of the market. Minor assistance in the stock market from quantitative easing, of course, minor assistance, not major, minor. The primary assistance has come in the financial sector, right? But of course, the overall low interest rates have provided a pretty good credit market for corporate debt. Corporate debt was low a few years ago. It's much higher now. Corporations have borrowed money for, I think, for the most part, more so stock buybacks than actual expansion projects, capital expenditures for forward-moving expansions. And that's a little bit frustrating. But if you're an investor, it doesn't matter because it's increased the earnings per share. The question is, though, is that at some point you have to continue to expand for the future. Otherwise, your valuations hit a brick wall. So I've talked about that in the past. We've got interest rates are going to be coming up over the next year or two. And once the interest rates trend upwards, we're going to see probably some type of a shift in things. I've talked about that many times in the past. So point 4, more significant improvement in earnings due to buybacks and cost cutting. So I've talked about that. Point 5, revenue growth has not kept pace with earnings growth, but has been neutralized by buybacks and cost cutting. This cannot last forever. Okay, I don't want to sound like the doomsday doctors, but this is just a reality. There's no doubt about that. Number 6, longer term improvement in credit risk, but recent (parentheses) irrational weakness in the credit risk. So some of that's irrational, some of it's not. Depends upon the credit we're talking about, whether it's sovereign credit, where the sovereign credit is, if it's in Europe, right? If it's in Asia, or if it's corporate. So there has been an improvement in the credit risk over the past few years, but over the past probably 8-10 months, especially over the past couple of months, credit risk has heightened. Investors are more worried about the debt. So I think a lot of it's irrational, just depends upon what we're talking about. I think, for U.S. corporations, it's irrational, without a doubt. Now, I should add a corollary to that, or caveat. Of course, that would be some of these these MLP companies that have borrowed a lot of money. But other than that, I think it's pretty irrational. And then point 7, EU banks still not stable. There's been very little improvement since the financial crisis in many of the European Union banks. I don't care what they say. There's really not been a whole lot of improvement. China is still a huge risk. I talk about that almost every single month. On the one hand, we don't want to keep crying chicken little every month, right? And, put our head down and hide in the corner, right? That's just the wrong move. But we want to acknowledge the risk, okay? And so we continue to extract profits in the stock market, in some cases even FXI, right? Trading the Chinese market if you're aggressive enough. But we're not worried about it. We're concerned. We're watchful. But the Chinese economy, the problems can spill over to cause a global problem. There's no doubt.